When you're starting your technology company, the C corporation is the primary business entity that you are going to consider forming, and it's going to be a C corporation in Delaware. This is important because as a technology company, you most likely will be going after venture financing, and venture capitalists will invest only in Delaware C corporations. You should consider the limited liability company or the S corporation if venture financing isn't imminent, and if you may be able to take advantage of some of the tax benefits of the limited liability company and the S corporation. Be aware that if you start operating your technology company and you haven't set up a particular business entity, then the technology company will be considered a general partnership if there's more than one individual involved in the company, or a sole proprietorship if only one person is operating the company. If you've operated your technology company and there's only one of you involved, then you've established a sole proprietorship. A sole proprietorship is a business that is not distinct from its individual owner, and a sole proprietorship is formed by an owner who simply starts conducting business. There are some advantages to a sole proprietorship. It's easy to form. All you have to do is begin to conduct business. It's also inexpensive to form. There are no particular filing fees for establishing a sole proprietorship. You may need to file an assumed name certificate with a county if you are operating the business in a name other than the owner's name, but this isn't required. Also, the sole proprietorship is not subject to double taxation, which means that any of the profits and losses of the sole proprietorship will flow through to the individual owner and will be claimed on the individual owner's taxes. The disadvantages of the sole proprietorship are that the sole proprietor is subject to personal liability for all of the debts and the obligations of the company. A big disadvantage is that the sole proprietorship is not going to be able to attract venture financing for the company. This is not an option that should be considered for technology companies, but it's important to understand that if nothing is formed and only one person is involved in the company, then this is how the company will legally be viewed. If two or more owners of a technology company are operating the company and haven't formed a distinct business entity, then they will have formed a general partnership. And a general partnership is when two or more owners are associated with each other to operate a business for profit. Some of the advantages of a general partnership is that it's very easy to form. Typically, the owners of a general partnership don't need to file a particular filing with the state or with the county to establish a general partnership. They just start working with each other on a business. There may be a filing that the general partners can file at the county level, but this often is not required. It's also pretty inexpensive to form a general partnership because there aren't filings that are required. The one expense that may be involved is with an attorney who develops a partnership agreement for the partners. Another advantage is that the general partnership is not taxed at the entity level, but is a flow-through entity, which means that the profits and losses of the general partnership flow through to the individual partners, and they're able to take those profits and losses on their individual taxes. There is no double taxation with a general partnership the way there is with a C corporation. And finally, the general partnership is distinct from its owners, which means that the general partnership is able to hold real estate and transfer real estate or transfer other property in the general partnership's name. There are a number of disadvantages to the general partnership, one being the unlimited liability of the debts and obligations of the partnership. That means that the personal assets of the general partners are subject to liability. Another huge disadvantage of the general partnership for a technology company is that it's not able to attract outside investment. As I mentioned earlier, technology companies most often are going to be getting venture financing, and venture investors will only invest in a Delaware C Corps. A final disadvantage of the general partnership is that general partners have fiduciary obligations to the general partners in the partnership. This means that the general partners have heightened duties to act in the best interest of the general partners. This is different than a limited liability company or corporation, where the owners can decide whether they want to have this heightened fiduciary obligation by taking on a management role in the company. The most important thing to understand for founders of technology companies that the general partnership is not the favored form to attract venture financing and is not the favored form in terms of liability. So this isn't a form to be considered, but it's important to understand the characteristics of this form as you are operating your company and if you have not formed a particular business entity.